Hi, everyone. I hope you can hear me. And we're just going to wait for a few minutes here until we get everyone on board. And once we do, we're going to kick things off. But thanks again for joining, and we'll get going in a minute or two. And in the meantime, actually, if you want to share where you're joining us from today in the world, that'll be really good to know, and that'll be really nice. Melbourne, wow, Australia. That's brilliant, Amanda. Welcome. That must be, what time is it there now? 10 a.m. So it must be in the evening your time. Brazil. Great, Grazielli. Thank you. 7 p.m. Cool. Good stuff. Okay, we'll kick things off and we might have more people joining as we go. But thanks everyone for taking the time this morning. I've just clicked on record. So, we're going to be recording this session for our own purposes. I'm going to turn off the chat for now. I'm going to enable it again later on in our live chat kind of section, live Q&A section at the end. Actually, sorry, one thing actually, I'm gonna enable the chat one for one more second because I just want to make sure that you can see what I'm presenting here. So you might just say yes if you can see the actual PowerPoint presentation. Is that okay? So you can see it? Okay, brilliant. Okay, thanks guys. Okay. I'm just going to disable the chat now, 2 seconds, and then we'll get going in earnest now. Okay, look, this webinar is all about how to attract private equity to your business, okay? I want to give you a kind of a high level understanding as to who I am. First of all, my name is Donald O'Sullivan. I'm based in Dublin, Ireland here, but I live on a plane. Interesting, Amanda. Yeah, like I've done a lot of work over in Melbourne, in Australia, and over the years, I love it down there. So we're very much a global organization, even though we're based in Ireland. What we do is, I suppose, look at a high level, we help business owners and leadership teams to navigate through difficult decisions, in particular around growth, and be that investing or raising capital or preparing for exiting their business. We're doing it for probably 10, 15 years now. And yeah, we've completed transactions across the globe in US, Europe, Australasia, and we're continuing to do so as we speak. I can touch on that a little bit later. What gets me going really is I just really love helping people, to be honest with you. That's why we run these types of sessions as well. It's always really good when people actually get to understand, I suppose, how to build their business via acquisition or how to prepare for taking on private equity or how to sell a business. It's always a real joy for me to see that come to fruition. Delighted to have you all here today. So without further ado, I'll talk you through the agenda. This is a very much an Irish centric kind of online webinar. Obviously, if there are interests in covering different areas, we can certainly do that at a later date. But just to make it clear for everyone here that this is going to be focused on what does the private equity landscape look like in Ireland. So that's what we're going to cover first. There are a number of UK private equity firms investing in Ireland as well. We're going to touch on them. We're going to talk about some transactions that have occurred in recent times in Ireland that involve private equity. I think it'll be interesting for everyone to get a sense of what's happening in that regard. We then wanted to take things back a little bit and just start from scratch, really, with regards to how private equity firms actually operate. Because to some SME operators and owners, it can be quite daunting, like listening to private equity firms speak. And what we want to do is we want to really demystify all of that, because quite often private equity firms have significant amount of capital under their remit, and that can seem a little bit overwhelming. So we want to take things back to scratch and really explain to people how they operate, what do they look for when they consider M&A opportunities. And then we're going to talk about the nuts and bolts of this, which is all about how do you attract private equity investment to your business, because that's the key bit. Then we're going to talk about how to identify suitable private equity partners, the key word being suitable there. Then we're going to talk about how to engage with private equity once you've identified them after having attracted them. Then we're going to finish off with how Vico Advisory can actually help support businesses going forward. And then we'll have a live Q&A at the end. So this is what the current landscape looks like. These are the Irish-centric private equity firms. These would be private equity firms that are run by Irish investors who have Irish investors. I should say they're run by Irish managers. They have a lot of Irish investors. They would have also some foreign investors as well. But there's 2 pages of this. So really at the moment, we really only have about 10 to 15 proper private equity funds in Ireland. And so it's a relatively small number, but to put it into context, when I started, I suppose, investing, I previously invested capital on behalf of a high net worth individual that was back in 2014. Some of these private equity firms didn't exist back then. And so I think while there aren't a huge number of private equity firms in Ireland at the moment, it's the number of private equity firms is certainly growing. And that's a very positive development for Irish business, because what has happened in the past is that like a lot of SMEs grew to such a decent scale, and then they were reliant on UK private equity firms or US private equity firms to buy them out. And they needed to reach a proper scale for UK and US private equity firms to be interested in acquiring their business. And so quite a lot of businesses obviously failed to meet that threshold. And then their exit, I suppose, was very limited. Quite often you were getting CEOs and owners selling to management teams through an MBO or like a management buyout. Quite often businesses would just actually close their shop, liquidate the actual assets in the business and roll off into the sunset without actually realizing the full value of their business. So it really is positive to see the growth in Irish private equity. And as well, like to see the kind of scale of the funds that are being raised at the moment. So you'll see MML and Cardinal would probably be the biggest traditional private equity firms that exist in Ireland at the moment. The current PE fund size of around 220 to 250 million. A note on just, I suppose, on the deployment, the percentage deployed, that's just a guesstimate from our perspective as regards how much we think that they've actually deployed of that current fund size. And it also gives you a sense as to the typical investment types. So some private equity firms will favor a majority buyout. It might not be a 100% buyout, it might be a strong majority. Others might favor a significant minority. And then there are others that will be flexible in terms of their approach and would use that flexibility as a USP. You can see the equity check ranges as well per transaction, and they do vary across the board, as you'll see. In terms of another key differentiator is, I suppose, all of these businesses, they invest in a range of different sectors. Now, they do typically invest in similar sectors, but some of these private equity firms would be a little bit more focused on certain sectors than others. So take MML, for example, like they have invested across a range of different industries like business services, healthcare, financial services, engineering, technology. One in particular transaction that they completed a number of years ago in the engineering space, H&NV, has been a roaring success for them, and that business has grown like a rocket ship over their period of ownership. Cardinal, similarly enough, would have invested in technology, healthcare, business services, consumer, financial services. Interestingly enough, Cardinal and Melior, you'll see right beside them there, they used to be, I suppose, one private equity firm previously, and that was called Cardinal Carlisle. It was an amalgamation between Cardinal and Carlisle, as the name suggests. And so they collectively invested in a number of businesses and were quite successful in doing so. And then in 2022, they parted ways and Melior raised their own fund of 160 million, which they're currently investing at the moment. And Melior they've been investing in some technology businesses, financial services businesses, consumer businesses like Salmon Software, which is a kind of a treasury management technology solution. And then even like their consumer business is in sweets, actually, would you believe? Development capital that spun out of BDO, the accountancy firm, they've raised 75 million, and they've been very successful in deploying that capital. What I think the reason why they've been quite successful is I think that they've found that nice little sweet spot around in minority investing, where an awful lot of the other funds would be focused on majority predominantly. Development capital are focused on going on a journey with founders and CEOs of businesses to grow their business by taking a significant minority position in the business. So the types of businesses that they've been investing in some technology businesses, some engineering businesses like Buttermer, even business services like IP technology, which would be a business IP telephony service for SMEs, and then consumer as well. They'd have some food type businesses. Oh, sorry, I'm after going on to the next slide. Addis as well have been very successful. They have raised about a 75 million fund relatively recently and are deploying that at the moment. It's very flexible in terms of their approach. They would focus on management buy-ins, management buyouts, and they would really want to go on a journey with entrepreneurs and owners of SMEs. And similarly, they've invested across a range of different industries. technology companies like Capture, which is, I suppose, a point of sale technology business, financial services business. A lot of businesses, a lot of private equity firms have actually gotten into accounting firms of recent because there's a significant opportunity there to roll them up. And Rambus have done similar. And then finally, Arisbeg have raised 110 million. I believe they're also raising another fund at the moment. And similarly, across the board, they've invested in engineering businesses, ORS being one a good example of a business that's doing really well under their steam. But they've also gotten into some healthcare and some business services businesses as well. So this is our second page of Irish-centric private equity firms. And the reason why I say that is because obviously there are some UK private equity firms as well that I'll be touching on next. Of keynote on this page, I think, is Waterland. So they obviously raised a 3.5 billion fund, but it's not just focused on Ireland, it's to invest across Europe. But they have invested quite a significant amount of capital in Ireland over the last probably 4 years since they joined. Laura Dillon's been doing a great job in there with their team. And the kind of areas that they've been investing in is more around nursing homes, engineering related businesses, so fire safety in particular. It is quite a substantial business under their ownership. But also of note is the BGF, which would be the British Growth Fund, who entered Ireland probably about 4 or 5 years ago as well, and who raised about a 250 million fund to do. And they have completed a significant amount of investments. You'll see there 24, that includes Northern Ireland transactions. And I think that would have probably included transactions that they would have completed prior to them technically setting up shop in Ireland, because I think their British Growth Fund could have invested in Northern Irish businesses previously. But a keynote there is, again, they're minority investors, right? I think a lot of CEOs and owners of SMEs, they think that private equity is really all about the buyout, but it's not always the case, because there are, I hope that I'm getting the point across, that there are flexible investors here who take a view and who create a solution for whatever outcome that is required, be that a minority investment or a buyout or a mix of the two. FL and Broadlake are also very interesting. FL would do a lot of real estate investing as well, but they've been very successful over the years in investing in a small number of assets. Their key one was in the yacht space, Sunseeker. And Broadlake would have, I suppose, seven businesses in their portfolio across a range of different industries, from healthcare. TTM Healthcare is their nursing, I suppose, placement business down in Ennis. And then they would have some business services businesses around the facility management space, 2468 being one of those businesses. And then finally, Gresham House is a relatively newcomer to Ireland. They raised 65 million in 2023, and they haven't really put a huge amount of capital to use yet, as far as I can tell. And they are flexible with regards to how they invest as well, which is positive too. Next point I wanted to touch on is that, given the fact that I suppose Ireland has been seen as being relatively nascent from a private equity firm perspective or activity perspective, there have been a number of UK private equity firms coming into Ireland, and I've listed out a couple of them here, and they do go from one end of the scale to the other, I would say, where your exponents and your inflections in particular would invest in quite substantial businesses. The types of businesses that they would invest in would be doing 10 to 20 million EBITDA, right? So that's on one side of the spectrum. And they have invested in a number of Irish businesses, like Knightsbridge, which is quite a large healthcare business up in Northern Ireland, would be one of them. And a number of others. So Chanel Pharma as well would be another one out in Galway, Mayo area, and is another business that was invested into by them. So for large transactions, large businesses, you'll definitely always get some UK private equity firms interested. TA Associates is another one that's not on this list here. They've acquired one or two large Irish businesses that we'll touch on later. But another interesting point as well is you'll see Duke Street in the middle there. They don't actually technically have a traditional fund structure. They acquire businesses on a deal by deal basis, and they have been doing so for, I'd say, 25 years now or so, in a very successful manner. And so what's good about that is, I suppose, is they have more flexibility with regards to the timing in which they invest their capital, because, and I'll touch on this in a little bit later in greater detail, but when a private equity fund raises its fund, the clock starts ticking in terms of when will they deploy that capital. And they are almost at the whim of interest rates to a degree at that point as to how expensive assets are, because obviously what happens is if interest rates rise, debt gets a bit more expensive, and it can be quite difficult to attain as well, and there can be greater scrutiny. And this is what we would have seen probably in the last 18 to 24 months. And therefore, larger transactions become more difficult to complete. So whereas Duke Street, they technically raise a fund for each transaction, if that makes sense. So it's a bit more flexibility for them. Volky then they've invested in version 1, which is a great success story for them, an Irish IT business. They typically invest in majority as well. And as you can see, we're getting a bit higher in terms of the equity check versus your Irish private equity firms would typically invest. Then on the flip side, then I suppose Lonsdale would be quite a smaller player, but nonetheless active. You'll see that their fund size wouldn't be as large as the others, and they've only raised the one fund, but they have been active in Ireland, and they are interested in investing in Irish businesses, and they would come in at that kind of smaller level. Sonova are a great Irish story. Actually, it's run by an Irish entrepreneur, and they've raised their 5th fund now at quite a substantial level, and they're very flexible in terms of how they invest. You can see the types of equity check sizes that they will invest in, but they're very active, especially in Ireland. Next, I'm just going to take you through 2 pages of transactions that have involved private equity. And I wanted to include these because what I'm showcasing here is in 2024, there were 74 private equity transactions completed in Ireland. And already year to date, there's been 20 transactions by private equity firms, be they Irish private equity or US or UK private equity firms, into Irish businesses. And this doesn't include even the bolt-on transactions that I suppose private equity backed businesses have completed, if that makes sense. And I'll touch on what a bolt-on transaction is later on. But these are just merely investments from private equity firms into Irish businesses. So you could consider them platform deals. Now, unfortunately, as you can see, nowadays, businesses don't tend to, I suppose, report the valuation of the transaction. You have to dig through the financial statements after they're reported in times to come to really understand exactly how much they were acquired for, and therefore what kind of multiples they were acquired for. But so I'm only reporting the information that I have available to me that's in the media. But you can see there's quite a substantial amount of activity from all the way from technology businesses like First Derivatives, which is a great success story of Brian Conlon's, unfortunately passed away a number of years ago, but was listed, was taken private by TA Associates there for over $500 million, all the way to smaller businesses like Plotbox there that focuses on funeral technology, shall we say, invested into by a US private equity firm. And then, as you'll see there's the usual suspects there of Cardinal Capital with HLB, Renatus with Strata, TA Associates again with Clan Group, which is quite a substantial healthcare technology business in Ireland. And then Woodbury, who would be more of an alternative investor. Didn't include them on the slide previously because they've done a lot of real estate investing and not a huge amount of business transactions, as far as I know. And then there's Cordovan as well, which would be a kind of a Northern Irish based equity firm. This is the second page then. Again, I think the key point to note here is there's a range of businesses being acquired in a range of different industries. You'll see across the board from engineering to beverages to education, technology, and also that there's actually quite a diversity in terms of the actual acquirers. So I think MML are the only business that I've listed there twice. And that's really positive because it shows that there's a real interest in Irish SMEs and a real acknowledgement that there are some great Irish businesses being established in this country. Our partners are worth touching on. I can't remember the scale of their fund, but it's quite substantial, and their focus is very much on sustainability, which is again an ESG, which is again quite a diversification or a kind of a differentiator for them, versus other Irish private equity firms, I would say. There are a couple of players there like White Rock and Pollen Street who would be more on the debt side. They probably would have the ability to provide some equity as well as but debt would be their main focus. And then you'll see there the usual suspects of Airspag and BGF. A quick note there on Exocean, like they raised 115 million for their business now, so it technically wasn't a buyout. But I wanted to include it because it's a phenomenal example of a great Irish business that's really mastering their own niche within the marine industry from a technology perspective, and as a result, they managed to attract the likes of Morgan Stanley's and private equity fund to invest in their business. So the next point is that I wanted to bring you through is how do private equity firms actually operate? So I think, as I alluded to earlier on, at a high level anyway, private equity firms, they typically operate via either a traditional fund structure on a deal by deal basis, or they complete deals on a club basis or kind of co-investment basis. What usually happens is first time private equity fund managers, they will usually start their fund by raising capital on a deal by deal basis. And they'll do because of the fact that it's quite difficult to get, especially if they're looking for institutional investors to invest in their private equity fund because it's the first time fund. And there aren't that many institutional investors like pension funds or endowment funds or even some high net worth investors won't invest in first time funds. So it can be quite difficult for a private equity fund manager on their first time out to actually raise a fund. So they'll find a deal and they'll negotiate that deal, obviously pending being able to raise the capital, and then they'll raise that capital and complete the deal. It sounds simple, and in some cases it can be quite easy depending on the transaction, but it can be quite difficult as well. And so they might do maybe 3 or 4 transactions on that basis, and they would do what would be called warehousing those deals. And once they've warehoused those deals, maybe it might be 3 or 4 transactions, then there's enough substance there for them to be able to return to their investors and say, okay, I appreciate the goodwill and the faith you've put in me to actually fund these individual deals. I'd now like to put a traditional fund structure in place. And I suppose traditional fund structures are, you can do it one of 2 ways. You can be a regulated fund or you can be an unregulated fund. And more often we're seeing regulated funds in Ireland. There has been quite a substantial amount of regulation from the Central Bank of Ireland in particular that has really improved the private equity scene, I would say, because it has created an ecosystem of advisors and checks and balances that are now done from a regulatory perspective that keeps everyone in line. And I think it's a very positive development, even though it can be quite cumbersome while you're in the midst of it. I think it's very positive with regards to ensuring that there's good fiduciary duty across the board, be that in terms of the usage of investors' capital by the private equity firms and also within the SMEs that they actually invest in. I'll touch on traditional fund structures now in a second, but just the final point, the other way to do it would be in an unregulated fund structure. You could establish a legal entity and you could gain commitments from investors within a holding company and then invest that capital from that holding company in an unregulated sense. But obviously it provides more security for investors if your fund is a regulated entity. Club deals are ones where, and this might be catered more for the deal by deal basis type of investing model, but especially where, say, you may have raised capital from an institutional investor, but it's just not quite enough to complete a transaction that you need to complete. And you may have some connections with some family offices or high net worth individuals, and where they might be comfortable to come in on a co-investment basis to club together to acquire the business that you don't have enough capital for. That's the type of concept within a club deal. And it's really beneficial for both parties because obviously the private equity fund manager can now complete the transaction that they want to complete. And the family office can gain access to that type of investment that with that kind of risk reward profile that they might be looking for, which they may not otherwise gain access to. And they can deploy a relatively small amount. It could be a couple of million to just top up the requirement to actually complete the transaction. So they're gaining that benefit too. So there's benefits for both sides. But in terms of the traditional fund structure, how does that work? So you may have heard of this concept of an LP/GP structure. So LPs are limited partners. They invest in the fund. So those would be your pension funds, your endowment funds, your high net worth individuals, your family offices, and they would return after a predetermined number of years. Like traditionally, their funds are going to be locked up for anywhere from 7 to 10 years. That's again in the traditional fund structure sense. And then the GP is the general partner. So they're the actual promoter of the fund and they invest the capital that has been raised by those limited partners. So they manage the day-to-day operations and the investing of the fund's assets. Typically, a private equity firm, what they'll do is it'll take them maybe 2 or 3 years to invest the capital that they have raised. I should say as well, before that, it can typically take anywhere from 1 to 3 years to raise a fund, really. And then once that fund is raised, then it takes 2 to 3 years to invest that capital, typically. Then the private equity firm will hold on to the investments that they've, I suppose, acquired or invested into for another 2 or 3 years to grow the businesses, improve them, professionalize them, And then it might take another 2 or 3 years to divest those assets, to sell them on to either another private equity firm, or to list them, or to sell them on to a trade buyer, or whatever it might be. In terms of the remuneration, I just wanted to include this as well. So the general partner, obviously, they are in the thick of it. They're coming up with the solutions. They're coming up with the investment opportunities, and they're negotiating the transactions. And in quite a few instances, they're then becoming quite operational in the businesses. So their remuneration is typically and traditionally has been referred to as 2 and 20. Now that can vary. That could be 1 and 15, either for early stage private equity funds, or it can be 1.5 and 25. There's various different ways of skinning that cap, but typically what that means is the 2 refers to the annual management fee. So if a private equity fund has raised 100 million, then they can charge, technically, they could charge 2 million to basically fund the salaries and the bonuses and your rent, like your business development costs as well, to actually run the actual private equity fund. And then the 20% that refers to the carried remuneration, and that's calculated basically on the uplift of the value that is created by the private equity funds. For example, just take one transaction. If you bought a business for, say, 10 million, and you sold it for 20 million in 7 or 8 years at the end of the fund's life, you have obviously you've gotten 2x your money, and you would need to calculate the IRR, the internal rate of return, which is where the NPV equals 0. So that's net present value of the investment. And again, that's getting a little technical. I'm not going to get into that great detail here, but basically you'll see there that the carried remuneration has a hurdle rate of typically around 7%. So what that means is if the IRR is less than 7%, looking at that transaction, then the general partner won't get that carried remuneration of 20% of the uplift. But if it is higher than 7%, then they're in the money. So I wanted to cover that off at just a high level on this webinar. And then typically a private equity fund, they target a kind of a 3 times money on like return on invested capital, basically, and a 20% IRR. So what do private equity firms look for when they're considering their M&A opportunities? They have various different investment criteria, as you'll have noticed from the previous slides I included about the Irish and UK private equity firms. But typically speaking, you can boil it down to these 3 types of private equity firms, especially in terms of SMEs and in Ireland. So there are some private equity firms that will have target sizes of 10 to 50, 50 to 100, and some that are over 100. Check sizes then of 5 to 25, 25 to 50, and over 50. Level of debt, like this is interesting and important. Like most now would be in that kind of, I would say, 3 to 5x EBITDA range. Some are a little bit more conservative. They'll be down at that kind of lower end of kind of 2-3 times EBITDA. And then, especially in the US, like any US private equity firms that are looking at Irish transactions, they have better access to debt funding, I would say, and just their risk profile is often quite different to traditional Irish private equity firms. Partly that's because of the availability of debt here. It isn't anywhere near what it is in the States, or even the UK for that matter. And so I think you'd find that larger US, UK private equity firms would be in that kind of 5x plus EBITDA range from a debt perspective. But just wanted to lay that out. Obviously, as I mentioned, fund structures can be different. Business types can be different. So some private equity firms will solely focus on B2B. Some will solely focus on B2C. Some will do a mix of the two. Some will focus on B2B2C businesses as well. So there's a range. And then the investment type can be different. So majority, full buyouts, flexible kind of MBOs, MBIs. So there's a range of different types. Sectors there, it might be a bit confusing, but primary sectors there that really, talks about extracting raw materials from the earth. Secondary is around taking those raw materials and transforming them into goods. So say the electronic space, for example. And then tertiary is around services. So all the services that make the products or align to those products. And that can be anything from accounting to recruitment to various different things. So as you can imagine, a significant amount of the transactions are completed in that tertiary sector space, albeit there are transactions that obviously occur in the primary and secondary spaces too. And then industry-wise, there's various different industries. I've just listed a couple here. And then the final differentiator between private equity firms is really post-transaction. How involved are they in the business? Are they hands-on? Do they take a back seat? do they engage with businesses on a board level perspective? I would say that the majority of Irish private equity firms, and even just transactions that are completed in Ireland, the majority of them would be the latter that I just mentioned there. So the private equity firm would typically have board either control or certainly representation on the board. They would engage with the management team at a board level, and they wouldn't usually get involved in the actual day-to-day running of the business. There are some private equity firms that have that, I suppose, want to do, and some kind of, especially more smaller, niche type players out there that we haven't really covered on this webinar, they certainly would get involved in running businesses more day to day than bigger players. Given the fact that there are differences between private equity firms, there are though some similar characteristics. And I suppose this is really what it comes down to. So I've just listed down there's probably about 10 characteristics that private equity firms typically look for when they're assessing whether they should invest in a business or not. And again, as I said, some private equity firms will look for different things in terms of, so taking revenue growth there, some will look for more stable growth, some will look for a bit more moderate growth, and others will look for kind of more faster growth at a top line perspective. I think strong management is always a must, typically speaking, for private equity firms. The reason why I've included the last column there, yes, but not a must, is because some private equity firms actually have a good kind of bench of operators that they can bring in to replace management teams if needed. But the majority of private equity firms look to back the manager that had been running the business in a really, really successful manner heretofore. Similarly, strong barriers to entry are typically a must, but some private equity firms, especially those that would invest in more cash flow deals where the multiples are perhaps maybe a little lower and they might have experience in that sector, it might not matter for them that the industry isn't, or that the business doesn't operate in such a strong barrier industry or have that place in the industry even. Bolt-on acquisitions, I mentioned it earlier. So this is where a private equity firm will acquire a meaningful platform business for a decent valuation and it's a decent business. And then they look to bolt on smaller businesses onto that platform business. And most private equity firms will look for that. Some won't. Some will just say, no, we only want organic growth because we've got a best-in-class product and service and management team and we know we can destroy our competitors. And some will say, yes, only if we stumble upon them. Client concentration is quite important. Some private equity firms will look for businesses where no one customer amounts to greater than 2% of revenue, total revenue. Some will be a bit more flexible on that, say 2 to 10%, and others will say, okay, for whatever reason, you have some substantial customers here, and they amount to quite a substantial proportion of your revenue. And so you were comfortable with that risk because they've either been clients of yours for a long time, they're showing good signs to grow with your business going forward. The dollar spend has been growing year on year. So that would be the way they would think about that. But it's always a risk and it's always an area of focus for private equity firms on a global basis, I would say. Attractive industries, I think, are a must. And by that, there's no point in buying the leader in fax machines, for example, because obviously fax machines nowadays they're probably still around, but they're probably 1% of a market versus what they were 20 years ago. So there's no point in investing in that type of an industry. And recurring revenue is obviously a key focus for private equity firms. They like to know that with certainty that they're starting on the 1st of January with anywhere from 50 to 75, 80, 90% of the revenue already committed through contractual recurring revenue. There's a slight differentiator between recurring revenue and reoccurring revenue, where obviously recurring revenue is contracted in nature, whereas reoccurring is more around you have clients that you know will pay you X this year based on just verbal commitments and long-standing relationships that you have with them. Or it might be regulatory requirements, but that's not actually technically contracted with your business, if that makes sense. Place in the industry, some private equity firms will look for the market leader only. Others will say 1, 2, or 3, and others will say, no, we want the challenger brand that's actually going to disrupt the market. And so there's a wide variety of tastes there. Capital expenditure, low, medium, high. Like obviously, private equity firms like to know that with a decent amount of certainty that the profit or EBITDA, earnings before interest, tax, depreciation, and amortization, that is a decent proxy for cash, so that they don't have to reinvest a significant amount of that going forward to grow the business. So I would say typically private equity firms would prefer more of a low capex profile. And then the final point would be technology adoption, especially given, I suppose, the advancement in AI nowadays. Even just SMEs having an AI strategy and deploying it to some degree in their business is very important these days. But even previously, before the real mass adoption of AI in the last, say, year, there would always be a focus to understand how does the business harness the power of technology to actually make their businesses more efficient. Okay, so now we're into the nuts and bolts of this. So the key strategies to actually attract your private equity investor in your business. So by building on what I just included there or covered there for in terms of the areas of focus within those private equity firms, you'll see that I've just basically included one more column there, which basically states your firm. So the point is you should assess your business against this set of investment criteria and take a really good, long and hard look at yourself in the mirror and say, where do we stack up? Are we at 10% of revenue growth? Are we at 30? Are we at whatever? Is our management team strong enough? Are there any gaps? Do we have a strong barrier to entry? And what is it? And if not, how do we make it stronger? Do we know of any bolt-on acquisitions? I think private equity firms love seeing managers and owners of SMEs who've either completed bolt-on acquisitions before, because then they know that they can do it and they have the appetite to do it. But two, that they have a list of transactions or bolt-on acquisitions that they are already in conversations with or know of at the very least that would be quick wins for the private equity firm once they back that team. Client concentration, obviously, as I mentioned before, is so critical. And how attractive is your industry? Are you in the fax machine industry or are you in the AI game? Just to keep that analogy going. Recurring revenue, where are you from a recurring revenue perspective or reoccurring revenue as well? Where are you in the market from a kind of a place? Are you a market leader? Are you a question mark? Are you a cash cow? Where are you? What type of a profile are you? And then from a capital expenditure perspective, is your EBITDA just going down to the bottom line, and is that the amount of cash that you're generating on a year-by-year basis, or do you have to reinvest that capital into the business going forward to maintain your growth? I think the private equity firms are okay with an element of capex as long as it underpins significant asset values that for which the business will be able to harness growth for a number of years going forward, as opposed to just short-term growth. And then finally, technology adoption. Where are you on that curve? So once you've done that, I think the next point then is create plans to actually address those gaps that you've identified in those applicable investment criteria. Address specific areas of interest. Client concentration and revenue growth are two areas that people can really focus on in a very short term to try and change things. Get your house in order. So we will actually be running another online webinar about this point specifically, about how to prepare your business for sale. I'm not going to go into this in great detail here, but at a high level, look, private equity firms, they love seeing businesses with good quality systems, policies, procedures, structures, governance, team, even just pathways for your second line of team. How are you going to bring them through? There's so much that business can do to actually improve their businesses at the same time as actually seeking to attract private equity investment. And that's something that we always say to our clients or prospective clients, that we're actually going to improve your business, even if whether you take on any investment from a private equity firm or whether you sell your business or not, we're going to improve your business. That's just a fact. Private equity firms, they conduct significant research into businesses. They're always scanning and analyzing, so they miss very little. I'm just going to have a quick check on time here. Another point is really consider, how does the business come across online and your own personal brand too? And then what marketing efforts could you use? And then the final point is it might not be to everyone's taste, but we're a firm believer that if you can build a strong management team, so if you as the CEO or the owner is redundant, that's going to be far more valuable to a private equity firm or an investor, because they'll know then that you can step away and you've got a good quality management team that they can back and to run the business if they want to do. Just to continue on that, look, the key thing is you've got to make sure the private equity investment is actually for you in the first instance, and it's not for everyone. And so the key there is to really take the time to understand what options exist. Ask yourself, who do you actually want to partner with and why? The why is the key point there. There's got to be cultural alignment and fit. You've got to like to work with these guys and girls, because you're going to be working with them for the next, it could be up to 10 years potentially, or it could be less. They might acquire your shares out over a period of time. in which case it might just be a 2 or 3 year period. But it's very rare nowadays for CEOs and owners of SMEs to be paid just a big wad of cash and just to be able to go off into the sunset on day one. What I would say is always identify and speak with other CEOs who work with specific private equity firms that you're interested in learning more about. Go to social events that the private equity firms host and just get to know them socially initially. Discuss your options with a corporate finance advisor, and then report back to your board of directors on your findings and obtain sign off to gauge interest from said private equity firms you might be thinking of. How do I identify suitable firms? Like, for starters, we're obviously going to say this, but we're a firm believer that this starts off with a valuation of your business. And the best people to do that is a corporate finance advisor. I'm not going to go into this because we will be running another online webinar on this in great detail. So at a high level, evaluation is based on similar transactions, similar comparative businesses, and the growth of your business discounted backwards. The key point is really to understand your capital needs, both yours and your company's, because again, like, it really comes down to what it is that you actually want from a capital perspective personally in your own life. Can consider whether debt is palatable to you and your business, and if so, at what level. I touched on the various different levels earlier on that certain private equity firms typically think about when they're looking to invest in businesses. So that's certainly something to bear in mind. And sometimes the highest valuation isn't always the best deal, because especially if the private equity firm is looking to load up the business with a substantial amount of debt, especially if you're rolling equity as a CEO or an owner in the business going forward, and that debt puts that both there and your equity under substantial financial stress. So you really have to think about that and find out as much information about how much debt is going to be in the actual, in the transaction structure going forward. So based on that information, work backwards, identify what's your ideal valuation, personal and company capital requirements, ideal debt to equity capital structure, and then a corporate finance advisor will use that information to identify and report suitable private equity firms for you. Engaging with them, and I'm going to run through this. Look, being polite is obviously given, but being professional at all times, it's really important to ascertain genuine interest, because some private equity firms can just find information on a fishing trip. If they have competing businesses to yours, share only the information that you feel comfortable doing. Yeah, that's a key point. Make them aware that there are other options out there and that they're not the only trick in town, because the more you can do that, the more they will want you, obviously in a very polite and business-like manner. And then reach out to a corporate finance advisor and to early in the process to manage the engagement with the private equity firm. So you'll typically then sign a non-disclosure agreement. Once you've done that, be upfront, tell them about the business, but do manage the information flow. You'll then look to gain a term sheet from them. And again, we're going to go through this in greater detail in another online webinar. So I'm not going to go through this in great detail in this time, at the time that we have together. But you'll typically look for a term sheet, and once you get that high level information across to them, and then a corporate finance advisor will review that term sheet and advise you accordingly. You'll negotiate that term sheet with the corporate finance advisor. Once you want to execute that negotiated term sheet, you'll be providing exclusivity to that private equity firm for a period. They'll engage their own advisors, so lawyers, accountants, tax advisors, to do some due diligence. It can take anywhere between 2 and 4 months typically. It is quite invasive, down to if you've been running your business like a personal piggy bank, which some SME owners do, that they can find it quite difficult to deal with that level of invasion. And that's why it's important to have a corporate finance advisor who can guide you through that. And they would also manage the communication strategically between you and the private equity firm, and that's a key point. Then there's legal documentation, then all going well through private equity, through due diligence. At which point then both your solicitors and corporate finance advisors, they negotiate the financial and legal clauses. You'll be guided through that, because obviously most SME owners and CEOs, they've never sold their business before. And so this is quite a new process for them. And a CEO or an owner of a business will be needed to provide advice or provide their view on certain areas within the legal documentation, in particular around warranties, indemnities, and disclosure letters. And again, we're going to go through that in a separate online webinar at a later date. So I'm not going to go through that in detail. But the key point really in all of this is, I think don't forget, if you're signing up to work with a private equity firm, you're going to be working with them post transactions. You have to remain businesslike and polite and professional, but all the while standing up for yourself and for what you believe is the true value of your business and the terms that you're willing to accept. I've just got a few more slides here, and then we'll get into the live Q&A, but this is how Vico Advisory can support businesses on their M&A journey. We provide sell-side, buy-side M&A advisory, debt finance advisory, financial due diligence, and we assist on post-transaction deal integration. We do operate across a range of different industries, and we are relatively sector agnostic. However, these are industries that we have completed transactions in over the years, over the past decade plus, and are certainly core areas of focus for us: testing, inspection, certification, and compliance, healthcare technology and services, financial services and technology, business services, and IT managed services. So I'll take you through to the live Q&A now. So I'm going to enable the chat function now. So feel free to send through any questions that you'd like. In the meantime, I do have a few questions here that we've prepared earlier, just to kick the ball off. What are the major benefits and drawbacks of taking private equity investment? One of the major benefits of doing so is the access to capital. So a lot of SME owners, they grow organically for a long time. And after a period of time, the rate of organic growth, it's quite difficult to maintain it to the degree to which it has been previously. In earlier days, it might be 20, 30% top line, and now it might be at 10% or lower. And the access to capital the private equity firms brings, and their expertise in terms of completing bolt-on acquisitions in particular, and the professionalism that they can bring to a business can be of great benefit. The drawback is obviously you've got to be comfortable getting into bed with someone that you'll have to take the time to get to know them. Because if and when things go bad, you've got to look in their eyes and make sure that they're in it with you, and that they're going to do whatever it takes to make it right. So I think that it can be a drawback of taking on private equity investment. Amanda just mentioned there, is it good or bad to have a high capital expenditure? I think it depends on the business, Amanda. Some businesses would naturally have lower capital expenditures. So services businesses and technology businesses would have lower capital expenditure. And then there are other industries like oil and gas, manufacturing, where there's a lot of machinery required that are naturally going to have high capital expenditure. But I think, as I mentioned earlier on, typically private equity firms like to see on the lower side of capital expenditure, because for them, they like to be able to see that EBITDA, or kind of adjustments to net profit, is a good proxy for cash. Because again, think of it their perspective, they've raised debt, so they need to, usually the interest on that debt is paid at the end of the term of the debt, but they like to be able to finance, and even they like to be able to use that capital to acquire businesses, bolt-on acquisitions, or to fund product development or whatever it might be in the business. I hope that's helped there. Chris O'Reilly, given how varied the investment criteria can be from deal structures to sector focus, what's the biggest mistake business owners make when pitching to private equity firms, and how can they tailor their approach more effectively? Okay, really good questions. I think what I would say the biggest mistake that business owners make when pitching to private equity firms is that they haven't taken the time, either themselves or by enlisting the services of a corporate finance advisor, to advise them on exactly the types of businesses that private equity firm is looking to invest in. That's the first bit. And then the second bit would be not knowing at what stage in the life cycle that private equity fund is at. So have they just raised a fund with loads of dry capital to deploy, or have they just finished deploying their latest fund and they're now not looking to invest in businesses because they're now out fundraising for the next fund, which will take some time. So I think that's something that I think I see a lot of times is CEOs and owners of businesses, they don't take the time to get to know the potential exit and the potential private equity partners well enough. And that's where a really good corporate finance advisor can really help a CEO or an owner of an SME. I hope that's helped. And then I suppose the other point, as you've pointed out there, Chris, is deal structures. So there's no point in you going into a private equity firm that only does significant majority or buyout transactions looking for a minority investor, because they're just going to say, no, it's just not what we do. It doesn't fit our mandate. Because in a traditional private equity fund structure, quite often they're limited in terms of what they can do. And because their limited partners will say, we've signed up to this type of a risk and reward return profile. And so their hands are tied. So I hope that helps. And then look, finally, I'm going to go back to sharing my screen here, because I just want to take you through. So hold on a minute. So if you want to book a free appointment with me, you can get your QR code up on your QR reader on your phone now, and you can do that. Alternatively, you can email us as well if you don't have the time to get your QR reader up now. Similarly, you can follow us on LinkedIn. There's another QR code for you. Again, you can find us on LinkedIn separately. We're Vico Advisory, and feel free to send us a follow on that. We've got good stuff coming up in terms of our plans from a marketing perspective. So it should be more of this kind of interesting stuff. So well worth a follow. We've got another masterclass coming up in a few weeks' time. And again, there is our QR code for that too. But again, if you're interested, just send us an email if you don't have the time to get your QR code up. There's a newsletter again. You can sign up on our website, vicoadvisory.com. If you don't have the time, just do it now. And then finally, thank you very much for your time. I really appreciate everyone staying on board until the very end. And there's my details there, my phone number and email if you'd like to contact me at any stage. I'd love to hear from you. And thank you so much again, and have a great day. Bye-bye.